everyone, welcome to the Tax Roundup for December. This month we're going to take a look at the revised reasonable food amounts for truck drivers and what substantiation really means. Then the new changes that are coming in from 1 July 2018 that impact how GST applies to property development. But first up, Michael Carruthers is going to take you through the changes that are now law that impact on investment property owners.
The bill containing a number of changes that will be relevant to rental property owners and property investors has passed through Parliament now and is just waiting royal assent, so we can basically assume that it's law. This is the bill that contains some of the key housing integrity measures that were announced in this year's federal budget. So the first thing is we've got a denial of travel expense deductions to the extent they relate to earning residential rental income from residential premises, and that kicks in from 1 July 2017. Secondly, the bill contains the changes to the depreciation rules, which is basically there to prevent depreciation deductions being claimed on assets used in connection with a residential rental property where those assets are basically second-hand. So they have been used by someone else prior to the client taking ownership of those assets, or indeed where those assets have actually been used for some sort of private purpose by the client as well. Now, not all assets are affected. It will depend on when the assets were acquired, and in some cases, the way those assets are being used throughout the 2017 income year. So for clients with rental properties, it will be necessary to kind of revisit the issue of their depreciation deductions on assets within those properties, not only for new assets and new properties being bought after 1 July 2017, but also having a look at what assets that were held prior to, first of all, prior to 1 July 17, but also prior to Budget Night 17 to see whether they could be affected. The third change in the bill is the introduction of a new vacancy fee, which can apply to certain foreign persons, and that could be individuals, it could be companies or trusts, where they are acquiring residential property in Australia, but not having those properties either occupied or genuinely available for rent for at least 183 days across a specific 12-month period. So again, if you have clients who are foreigners who have bought residential property, existing dwellings or land that is going to have a dwelling put on it here in Australia, if they've had to go through any sort of Foreign Investment Review Board approval to acquire that property, then again there's a chance that they could be impacted by the new rules, and it'd be important for them to understand what they need to do to ensure that those fees don't apply. So the bill, as I said, has passed through Parliament. Need to revisit our rental property clients to see what expenses could be potentially impacted, to inform the clients of what changes have now come through from 1 July 2017 onwards, and what impact that might have on their tax position for the 18 year, but also moving forward as well.
Now to that new tax determination on the reasonable food amounts for truck drivers.
Now, many practitioners would be aware that each year the ATO publishes some reasonable amounts for people who have received bona fide travel allowances or overtime meal allowances. And the whole idea behind those reasonable rates is within the tax system, normally to claim a deduction for something, you need to have evidence of the expense that you've incurred. So receipts or invoices or other evidence supporting the claim that you've made. But in some instances, those rules are relaxed a little bit. And that includes situations where an employee has received a bona fide travel allowance for overnight travel, or an overtime meal allowance, and where the deduction that they're seeking to claim doesn't exceed the ATO's published reasonable rates for that year. Now, for the 2018 year, the ATO actually had a slight change of approach when it came to the way those reasonable rates would work with respect to employee truck drivers. Now, in the past, what the ATO had done was publish a specific amount per meal, so breakfast, lunch and dinner for a daily basis while those truck drivers were travelling in the course of their work. But for the 2018 year, the ATO did away with those specific meal amounts and just came up with a combined daily amount. Now, that caused a bit of consternation, I guess, within the trucking industry, and as a result, the ATO has actually gone back to a specific amount per meal. So the ATO has updated its tax determination for the 2018 year to reintroduce specific amounts for breakfast, lunch and dinner. The ATO does indicate that you can't combine those things together. So if someone starts travelling after breakfast, then they can't include the breakfast amount in the reasonable amount for that particular day. The other thing that's of interest maybe more broadly, not just to truck drivers, but for other employees who might be travelling in the course of their work and who might receive overtime meal allowances or travel allowances for that travel that they're doing. One of the big question marks that has been for a number of years is that while we know that there's this substantiation exception, so you don't have to keep receipts for every single expense that you've incurred, but clearly the ATO has said to us that there is some expectation of records being kept. I guess where the gap has been is, well, what do you actually need to do as an employee to substantiate claims where you have received a bona fide allowance and your claims don't exceed the ATO reasonable rates? What is it that you're actually expected to keep? Now, the ATO's updated guidance in terms of that updated determination, it provides a little bit more guidance in terms of what might be required. The ATO has indicated you'd need some evidence to show, first of all, that you have personally incurred those expenses. So that could be bank statements or credit card statements that might show that the funds have actually come from one of your accounts. You'd need evidence that you haven't been reimbursed for the amounts that you've spent. You need evidence that you've actually, for example, travelled overnight on that day, and that could be records that have been provided to you by your employer. It could be a logbook or diary or something along those lines that you've kept. You need evidence of the fact that you've received a bona fide travel allowance, and that might not be on a payment summary, but it could well be on a payslip or some other documentation that you've been provided with. So as a starting point, that's the sort of documentation that the ATO might expect. But beyond that, the ATO indicates that you'd probably also need to keep at least some receipts or invoices to show the type of expenses that you're incurring on the trip. Now, in the context of truck drivers, the ATO has given us an example of someone who's travelling on the same route over and over again. And what the ATO said is that that person, where they're able to rely on the substantiation exception, they could keep a record of receipts and invoices maybe over a representative period of, say, 3 months. A little bit like keeping a logbook for car expenses, that 12-week, 3-month type time period, the ATO seems to suggest that that's the sort of expectation they would have in terms of what you need to support the claims that are being made. So you don't need to necessarily keep receipts for every single expense over the 12-month period, but a representative sample would certainly go a long way to supporting the deductions that are being claimed. Now, that example relating to a truck driver who's travelling the same sort of route over and over again is probably less relevant when it comes to another type of employee who's travelling to different places on different days and for different lengths of time. Not quite as easy just to keep a sample over 3 months maybe, because it might vary quite a lot through the year. But it does indicate the ATO does probably expect that some receipts, some invoices are kept, along with other evidence around the fact that you've travelled, the fact you've received this allowance, the fact that you have paid the money yourself. And employees should really be encouraged to try and build up that evidence to prove that they really are entitled to the deduction, even though they may not necessarily be keeping receipts for every single expense that they've incurred. And at a high level, I guess, pretty easy to say that the more evidence that the employee gathers and retains as part of their records, the better position they'll be in when it comes to any review or audit activity by the ATO. So for those who are able to rely on the ATO's reasonable rates, yes, there is a substantiation exception. The rules are relaxed, but there is still an expectation of some records being kept to justify the deductions being claimed.
And finally, that exposure draft that details how GST will apply to property developments.
Now, we've had Treasury release some draft legislation relating to one of the measures that was announced in the budget earlier this year. Now, this particular measure relates to GST treatment of certain property transactions. Now, at the moment, if a property developer sells new residential premises or vacant land and they're registered for GST, then typically that sale would trigger a GST liability, and the developer will need to report the transaction on its next activity statement and then pay the GST liability to the ATO. Now, for some time now, the government's been a bit concerned about problems in terms of enforcing that GST compliance obligation for some property developers. And this has also been an area where the government and the ATO have noticed a fair bit of Phoenix activity occurring. So a property developer sells the land, triggers a GST liability, but before the next activity statement is lodged, the entity is wound up and dissolved, and that makes it really difficult for the ATO to then recover the unpaid GST liabilities. In the budget earlier this year, the government announced that one way of trying to overcome some of those compliance concerns would actually be to push the GST liability obligation onto the purchaser rather than the vendor. So from 1 July 18, the government is planning to introduce, I guess, a new form of obligation that would sit with the purchaser. So if the purchaser is buying property from a registered property developer, the purchaser has to pay the GST amount to the ATO. Now, the way this is, at this stage anyway, planned to be structured is that the purchaser would have an obligation to pay 1/11 of the full sale price to the ATO. And that amount stays the same regardless of whether the developer would be able to apply the margin scheme. Often in cases like this, the property developer will be able to apply the margin scheme to reduce their final GST liability. Whether that's the case or not, the purchaser will simply have to pay 1/11 of the full sale price to the ATO. And I think that's just to save some of the confusion and provide a bit of simplicity around the process. Now, when that's occurred, the property developer will get a credit for that amount of GST that's been paid to the ATO. If they do use the margin scheme and are able to use the margin scheme to reduce their GST liability, then in most cases you would expect them to be able to then receive a refund back from the ATO for the overpaid GST amount. Now, one of the other features of these proposed new rules is that there'll be an extra obligation imposed on the property developer as well. What they'll need to do is, if they are in the process of selling new residential premises or subdivided vacant land to a purchaser, and it is a transaction to which these new provisions will apply, the developer actually has to give a written notification to the purchaser indicating that there's this new obligation, providing certain details around the transaction, and I guess just making sure that the purchaser has written notice that they need to pay this amount to the ATO. From a timing point of view, probably how it will work in most cases is that the purchaser will need to pay that 1/11 of the sale price to the ATO on or before settlement occurring. So as part of the settlement process, some of the money will go to the developer, some might go into kind of other bank accounts or banks or whoever it is, and then 1/11 of the sale price will need to go across to the ATO. So as we get closer to the start date, 1 July 2018, pretty important, I guess, for those involved in and around the property industry, whether that's property developers, whether that's lawyers and conveyancers, accountants, real estate agents, to start thinking through the practicalities of these new rules. Now, as I say, these are only draft provisions at the moment, but presumably the government is working towards having a final version ready in time for that proposed 1 July 18 start date. But certainly it will require a bit of change of thinking in terms of how the settlement process works, in terms of how the cash moves as part of the settlement process, but will represent quite a significant change in the way that the process does operate when we do have those taxable transactions involving new residential premises and vacant land when the developer is registered for GST.
And that's the tax roundup for this month. We want to wish you a wonderful Christmas and a safe and happy holiday season, and we'll look forward to working with you again in the new year. See you then.